Nothing is more crucial yet more misunderstood than the interplay of supply and demand. For the average man, the market appears as a chaotic whirlwind of rising and falling prices governed by news, rumor, and sheer chance. He buys on hope and sells on fear, perpetually one step behind the true movements of the financial tide. But for the trained observer, the market is not a mystery. It is a logical entity that, through its own actions, consistently advertises its future intentions. The key to deciphering these intentions lies in one critical skill: the ability to recognize demand. It is the ability to see the subtle but deliberate footprints of smart money as it quietly prepares the ground for a significant advance. Richard Wyckoff dedicated his entire professional life to mastering this skill and then to teaching it. He proved that predicting uptrends was not a matter of guesswork or inside information, but a science based on observable facts, logic, and a deep understanding of the market's fundamental laws. The foundation of his entire method rests upon the first and most simple of these laws, the law of supply and demand. This principle is as old as commerce itself. Yet, its application to the stock market was and still is largely ignored. Prices rise only when demand exceeds supply, and they decline only when supply is greater than demand. When the two forces are in a state of equilibrium, prices move sideways in a narrow range. Every fluctuation from the smallest eighth of a point wiggle to the grandest multi-year bull market is a direct expression of this continuous battle. The thousands of influences that other people use as a basis for their actions, news, earnings reports, dividend rates, political events, and personal opinion are all concentrated and boiled down into the combined effect of their buying and selling. This combined effect is all that matters, and it is all faithfully recorded on the tape and, by extension, on a price chart. Therefore, to predict a future uptrend is to accomplish one thing: to identify through a logical analysis of price and volume the point at which demand is quietly but decisively overpowering supply. This does not happen by accident. It is the result of a deliberate, well-planned campaign conducted by the most informed minds in the market, an entity Wyckoff termed the composite man. The primary evidence of this emergent demand is found in a market phase Wyckoff identified as accumulation. This is the first and most critical stage of any bull campaign. Accumulation is the process by which the composite man, the amalgamation of large operators, insiders, and skilled financial interests, absorbs the available floating supply of a stock from the public or weak hands. This process is conducted with great skill and patience, often over weeks or months, and its primary objective is to acquire a large line of shares without causing the price to advance significantly. To do this, the composite man must operate under a cloak of pessimism. Accumulation almost always takes place after a prolonged and often punishing decline. It occurs at price levels where the news is at its worst, where corporate earnings are poor, and where the general public, discouraged and fearful, is finally capitulating and selling its holdings, often at a substantial loss. This environment of gloom is precisely what the composite man requires. He has the foresight to see a change in conditions far in the future, and he uses the current bearish sentiment to his advantage, willingly taking shares off the hands of those who can no longer bear the pain of holding them. The entire process is a transfer of ownership from weak, emotional, and uninformed hands to strong, patient, and highly informed hands. Recognizing the distinct phases and characteristics of this accumulation is the key to predicting the subsequent uptrend. Sign number 1, the selling climax, the stopping of the prior downtrend. The first sign that a significant accumulation may be about to begin is the dramatic event that halts the preceding downtrend. This is known as the selling climax. After a stock has been declining for a prolonged period, public sentiment becomes overwhelmingly bearish. Those who bought at higher prices are discouraged and fearful. As the decline continues, this fear often turns into panic, and the last of the weak holders capitulate, throwing their shares onto the market without regard to price in a final, desperate attempt to escape further losses. This is the moment the composite man has been waiting for. He steps in with immense buying power to meet this deluge of panicked selling. On a vertical chart, this event is characterized by several distinct features. First, there is a precipitous drop in price and acceleration of the decline, often ending in a day with an exceptionally wide price spread from high to low. Second, this price drop is accompanied by an abnormally large or climactic volume of trading. This huge volume is the result of both the massive public selling and the massive institutional buying that is absorbing it. It is the point of maximum emotional intensity for the sellers. Third, a key characteristic of a successful selling climax is the price action at the end of the day or period. After plunging to its extreme low, the stock will often rally strongly to close well off the bottom. This shows that the buying power was not only sufficient to absorb all the selling, but was strong enough to reverse the immediate trend intraday. This is the first powerful evidence that the force of demand is beginning to overcome the force of supply. Preceding this climax, there is often a point of preliminary support where a noticeable increase in volume and a widening of the spread first appear, signaling that substantial buying is beginning to emerge. While this initial support is rarely enough to stop the decline completely, it is the first footprint of the composite man and serves as an alert that the end of the downtrend may be approaching. The selling climax itself, however, is the main event. It marks the point where the stock is transferred en masse from the weakest possible hands into the strongest possible hands. It is the violent and necessary conclusion of the downtrend and the first definitive sign that the groundwork for a new uptrend is being laid. Sign number 2, the secondary test on low volume, the confirmation of exhausted supply. Following the selling climax, an almost reflexive rally occurs. Wyckoff termed this the automatic rally. This rally is caused by the sudden vacuum of selling pressure. With the public having exhausted its supply of stock in the climax, even a moderate amount of continued institutional buying or short covering by bearish traders can cause the price to rebound sharply. The high point of this automatic rally is significant because it establishes the upper boundary of the forthcoming trading range. The market has now defined its territory. The low of the selling climax is the support, and the high of the automatic rally is the resistance. However, the most critical piece of evidence that follows is the secondary test. After the automatic rally has run its course, the stock will invariably drift back down to test the area of the recent selling climax low. This is a moment of truth for the market. If the heavy selling that caused the climax is truly over, then this test should occur on significantly diminished volume. The price will approach the prior low, but the volume will be a fraction of what it was during the climax. This is the second and vitally important sign of accumulation. A low volume test demonstrates conclusively that the intense selling pressure has been exhausted. There is little or no stock being pressed for sale at these low levels. The composite man, having absorbed the panic selling, now finds that the supply has dried up. He may deliberately withdraw his bids to see what the stock will do if left to itself, and the resulting low volume and lack of downward progress confirm to him and to the astute Wyckoff analysts that the sellers are gone. If, on the other hand, the secondary test occurs on high volume and the price breaks decisively below the selling climax low, it indicates that the liquidation was not completed and that a resumption of the downtrend is likely. Therefore, the successful secondary test on low volume is an indispensable confirmation. It validates the selling climax as a genuine turning point. It proves that the initial powerful buying was not just a temporary support measure, but the beginning of a deliberate campaign of accumulation. The stock is now safely contained within its trading range, and the composite man can proceed with absorbing the remaining floating supply with the confidence that the major selling pressure is behind him. Sign number 3, the gradual drying up of supply within the trading range, with the boundaries of the trading range established by the selling climax and the automatic rally and the exhaustion of major selling pressure confirmed by a successful secondary test. The lengthy process of accumulation begins in earnest. The stock will now oscillate within this range for what can be weeks, months, or even years, as the composite man methodically absorbs shares. This sideways movement is the cause being built for the future effect of a sustained advance. To the uninformed observer, this period appears as a lifeless, uninteresting market. But for the Wyckoff analyst, it is the most crucial period of study, for it is here that the most subtle yet powerful signs of hidden buying are revealed. The third and longest sign of accumulation is the gradual drying up of supply, which is observed through a meticulous analysis of price and volume on the swings within the trading range. The key characteristic of a genuine accumulation is this. Volume should tend to expand on the rallies from the support level to the resistance level, and it should noticeably contract on the reactions from the resistance back down to the support level. The consistently shrinking volume on each successive decline within the range is of paramount importance. It indicates that fewer and fewer shares are being offered for sale on each dip. This is direct evidence that the floating supply is being absorbed. Sellers are becoming scarce. The composite man may test the supply repeatedly by allowing the stock to drift down toward the support line. If very little volume appears on these tests, he knows that his campaign is succeeding. Another powerful indication that often accompanies this volume signature is the appearance of higher supports or higher lows. After the initial low of the selling climax and the secondary test, each subsequent reaction within the range may stop at a slightly higher level than the one before it. This shows that buyers are becoming more eager and aggressive. They are no longer content to wait for the price to fall to the absolute bottom of the range to acquire shares. They are raising their bids, a clear sign of their eagerness to accumulate more stock. This subtle but persistent lifting of the support points is a clear sign that demand is quietly but surely overpowering supply long before any public breakout occurs. The Wyckoff analyst meticulously charts these movements, drawing trend lines along the rising bottoms to visualize the changing character of the market. The stock is building a solid foundation, a launch pad for its future ascent. The opposite, a pattern of lower tops on rallies within the range, would be a bearish indication showing that sellers are becoming more aggressive and are willing to accept lower prices to distribute their stock. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. Sign number 4. The spring or shakeout, the final manipulative test. As the long process of accumulation nears its end, the composite man often employs a final powerful maneuver to ensure the path is clear for the coming markup. This is the fourth and frequently most decisive sign of a completed accumulation, the spring or shakeout. A spring is a sharp and usually brief price movement that penetrates the established support level of the trading range, only to quickly reverse and climb back into the range. This maneuver is a masterful piece of market manipulation with several calculated objectives. First and foremost, it is designed to mislead the public and any remaining weak holders. A break below a well-defined support line is almost universally interpreted as a sign of renewed weakness, prompting the last of the nervous long holders to sell their positions in fear of a new decline. It also encourages bearish traders to initiate new short sales, believing a new downtrend has officially begun. Second, the spring allows the composite man to hunt for stop-loss orders, which are predictably clustered just below the support level. By driving the price down just far enough to trigger these stops, he can force other traders out of their positions and acquire their shares at the most advantageous prices possible, effectively mopping up the last available supply. Third, and perhaps most importantly, the spring serves as a definitive final test of the supply situation. If there were still a significant amount of stock ready to be sold by other weak hands, the break below support would trigger a cascade of liquidation, and the price would continue to decline on expanding volume. However, if the accumulation campaign has been successful and the floating supply is truly scarce, the break below support will not be met with significant follow-through selling pressure. The key to identifying a spring as opposed to a genuine and bearish break of support lies in a careful analysis of both the volume and the price action that immediately follows the penetration of the low. There are two primary types of springs. The first type occurs on very low volume. This is a powerful indication that there was simply no selling pressure to be found at the lower levels. The supply was completely exhausted, and the price dropped simply due to a lack of bids. The second and more common type occurs on high or even climactic volume. This high volume represents the composite man actively absorbing the shares from the triggered stop-loss orders in the final wave of panicked public selling. In both of these scenarios, the defining characteristic of a true spring is the price's rapid recovery. It does not linger in the territory below the old support line. It quickly reverses and climbs back into the trading range, often in just a few bars or days. This swift reversal is one of the most powerful and reliable buying signals in the Wyckoff methodology. It is a clear sign that the last of the sellers have been shaken out. The track is now clear of any significant overhead supply, and the stock is now coiled like a spring, ready for a powerful upward move. The shakeout is a broader term for a similar action, which can sometimes involve a more substantial price drop or a more prolonged period of bearishness, but its purpose and identifying characteristics remain the same. To mislead the public and consolidate the remaining shares in strong hands just before a major advance. Sign number 5. The signs of strength and the jump across the creek. Following a successful spring or a final test of support near the bottom of the trading range, the stock enters the last stage of its preparation. The fifth sign of accumulation is the appearance of clear signs of strength, which culminates in the definitive breakout event that Wyckoff colorfully named the jump across the creek. A sign of strength is a pronounced rally that is distinctly different in character from the labored low-volume rallies seen earlier in the accumulation process. It is a movement on widening price spread and a noticeable expansion in volume that carries the price from the support level decisively towards the resistance level of the trading range. It demonstrates that demand is now firmly in control and that the path of least resistance is shifting to the upside. An SOS shows that the stock is responsive and ready to move. After one or more of these signs of strength have demonstrated the newfound power of the demand, the stock will approach the upper boundary of its long-standing trading range. This level of resistance, which has turned back all previous rallies, Wyckoff analogized as the creek. The jump across the creek is the decisive, powerful move by the price out of and above this resistance line. This is not a timid or hesitant breakout. A genuine jump across the creek is characterized by a notable expansion in price spread and a significant sustained increase in volume. This powerful action shows that demand is now fully assertive and is strong enough to absorb any residual supply that might appear from traders who had previously sold at those levels and now wish to sell again. This is the moment when the stock breaks free from its lengthy preparatory phase and begins its public advance, which is the markup phase. While buying during a spring offers the greatest potential reward due to the lower price, it also carries the inherent risk of misinterpreting the move. The jump across the creek, however, is a confirmatory signal. It is the market's unambiguous announcement that the period of quiet preparation is over. Very often after this initial breakout, there is a small pullback or sideways consolidation, which Wyckoff called the backup to the edge of the creek. This is a final smaller test of supply before the main advance gets underway. This pullback should occur on a distinct shrinkage of volume, once again confirming that supply has been exhausted at these new higher levels. This last point of support offers a final excellent low-risk opportunity for the Wyckoff analyst to initiate or add to a long position with a clearly defined stop-loss point just below the newly established support of the former resistance line. Sign number 6, superior comparative strength. Throughout the entire process of accumulation and at the beginning of the markup phase, Wyckoff stressed the importance of observing a sixth sign, the stock's comparative strength relative to the general market. A stock that is being genuinely accumulated by informed interests will exhibit distinct characteristics during broad market movements that set it apart from the average issue. While the stock is still consolidating within its trading range, it will often show a stubborn resistance to declines. When the general market, as measured by a composite average, experiences a sharp reaction, the stock under accumulation will frequently decline by a smaller percentage than the average. At times, it may hold perfectly firm or even rally slightly against the tide. This behavior shows that while other stocks are being sold freely, there is a persistent and powerful demand for this particular stock that is quietly absorbing any offerings and preventing it from falling. Conversely, on rallies in the general market, the stock under accumulation will often respond with greater vigor and speed than the average, demonstrating its eagerness to advance now that the general market's selling pressure has been lifted. This quality of superior performance becomes even more pronounced after the stock has completed its jump across the creek. Now, in strong hands and free of any significant overhead supply, the stock will often lead the market's advances and will be highly resistant to general market reactions. James R. Keene, the famous operator whom Wyckoff studied, once said, "Watch the stock that shows strong resistance to pressure when the market is weak, and buy those stocks for all you are worth." This principle of identifying superior comparative strength is a powerful filter for the investor and trader. It allows the analyst to not only identify that accumulation is taking place, but also to select the specific stocks that are most likely to become the strongest leaders in the coming uptrend. By focusing capital on these issues that demonstrate superior strength, the trader ensures that his funds are employed in the vehicles most likely to move the soonest, the fastest, and the farthest. Sign number 7, the unmistakable uptrend, higher tops and higher bottoms. The seventh and final sign is the logical result in confirmation of all the preceding evidence, the establishment of a clear, sustained, and unmistakable uptrend. An uptrend, in its simplest definition, is a persistent series of higher tops and higher bottoms. After the stock has completed its jump across the creek and a successful backup to the edge of the creek, it should begin to make steady upward progress. Each rally should push the price to a new high, and each subsequent reaction or consolidation period should stop at a higher level than the one that preceded it. This staircase-like upward movement is the visual confirmation that demand is in continuous control of the stock. The character of the volume must continue to confirm this trend. According to the law of effort versus result, volume should be strong and tend to expand on the advances, showing that there is enthusiasm and power on the buying side and that the effort is producing a positive result. Conversely, volume should noticeably contract on the reactions. This indicates that the selling is light and represents simple, healthy profit-taking rather than a renewal of concerted distribution by large interests. This final sign is the culmination of the entire accumulation campaign. The composite man's preparatory work is complete, and he is now allowing the visible uptrend to attract further public participation. This new wave of buying will help to carry the price up toward his ultimate objective, where he will in time begin the process of distribution all over again. The Wyckoff analyst, who has correctly identified the preceding 6 signs, is now able to participate in this markup phase with a high degree of confidence, managing his position by following the clearly defined trend until he sees the first definitive signs that the character of the market is changing once again and that a new phase of distribution may be on the horizon.